Well, we are not even halfway through November yet, but major investment groups are already rolling out their massive outlook documents this year. Investors paying extra close attention to forecasts for the Federal Reserve. We heard from Goldman Sachs, UBS, and Morgan Stanley, and the big banks did not seem to agree on what exactly we could see from the central bank in 2024. Our head of news, Myles Udland, joins us now to help us make sense of it all. Myles, make sense of it.
Thanks for having me in your new house. This is wonderful. I think as you would perhaps expect, you're seeing some divergence on the street in terms of what folks think is going to happen next year when it comes to Fed policy. But I think really the important thing is that for next year, this is the prediction that most people are most focused on. Usually we're sitting here talking about what else is coming out this time of year, which is 2024 S&P 500 price targets. And I know we can get into it with what Mike Wilson at Morgan Stanley said earlier today, but this year's main event is where economics teams see interest rates going. And as you mentioned, Josh, this morning, really the headlines coming from UBS out saying they're looking for almost 3 percentage points worth of cuts from the Fed next year, 275 basis points of what they're looking towards. But as you look at this graphic here, you can see Morgan Stanley a little more conservative, 100 basis points next year. The Fed itself is looking for 50 basis points in rate cuts next year. That's as of their September forecast. Goldman doesn't see any action until the fourth quarter, so could be September, November, December going to be, or really November, December going to be your options there. And then Barclays, they actually think there's going to be a rate hike in January 2024, and that will end 2024 at the same levels we are today, with rates in a range 5.25% to 5.5%.
Is there usually this much divergence in this kind of stuff?
Well, I think for me, it's usually we don't pay that much attention to it. I think for two reasons. One, the Fed itself puts out forecasts on where they think rates are going. So every investment bank is going to have their little, change on the edges of it. 25 basis points more or less than what the Fed says. But because the dot plot exists, and we'll get an update on that next month, there's no need to focus too much on where Wall Street economists forecast rates to go. And those economists don't spend too much time themselves thinking about it. They're like, we'll follow the dots and we think they'll be more or less conservative. And I think the other thing is we are clearly at an inflection point for Fed policy, which is not always the case. Most years, you have a pretty good idea of, where rates are probably going to go a little higher next year or a little lower. And though everyone agrees that the direction is lower from here, the speed at which it happens, why it happens, there's going to be a shift in how we all think about what role the Fed plays in markets and the economy next year, and you can kind of see it coming from this distance.
What do you make of Mike Wilson at Morgan Stanley in particular? Because this was a well-known skeptic, we know that, Mr. Wilson, says, all right, he expects about 12 months from now, the SPX, the S&P 500, to end 2024 at 4,500, so not a whole lot of upside there.
Basically flat.
Yeah.
I think what was interesting about Mike Wilson's note is, so stock's flat next year, fine. I think there's a lot of skepticism right now that the earnings forecast for next year will stop coming down. So if you start to see earnings per share forecast for 2024 continue to come down, it makes sense that markets will be flat. What you and I were chatting about before this, Josh, is that Mike Wilson's calling for 16% earnings growth in 2025. But the number one thing to me, at least, and I think some investors would disagree, but to me, the number one thing that matters for stocks is that year ahead of the year ahead earnings forecast, right? Like why stocks have gone up this year is because 2024, second half of 24 outlooks are coming down less than expected. Therefore, it's good, right? So you should keep buying stocks. So if we're going to say that 2025 is going to be almost 20% earnings growth, it's not clear to me why necessarily that wouldn't start getting priced in 2024 unless Mike just thinks we're going to start from a lower base. Are we going to be down 10, 15% from here come January, and then you get yourself back to level, then you do the rest? I mean, we can do all these mental twists, but to me, that 2025 earnings outlook says higher stocks in 24.
I mean, doesn't the Morgan Stanley economic outlook imply a worse scenario than some of the other banks?
Yeah, I mean, I think to me, and this is what I'm struggling with as I write about this and as I think about this, is like you get to rate cuts from the Fed in a couple different ways, and the way you get there matters a lot for the stock market. If you get rate cuts from the Fed because inflation comes down, you have this soft landing, right? Then yeah, you're definitely going to see higher stock prices. That's going to be good. All else equal, lower interest rates, higher stock prices. If it's because of a recession, well, then we get into all the numbers around what happens to earnings in a recession. Typically, they're down by 30% peak to trough. I am struggling to see why you would have even a flat market next year with earnings coming down 30% from peak to trough if we are indeed tipping into recession. And so I think at the heart of these disagreements from these firms and kind of that outlook we had on where the Fed goes next year is really a disagreement about, do we have a recession? And then if we do, what's the magnitude of that recession? Because clearly, you look at what Goldman has said, what Barclays said, they are not really looking for a recession next year.
Right. I mean, the divergence seems to me to be rooted in what we've seen this year, which is everyone was wrong, right? And so if you're a strategist, whether on the equity side or on the economy side, and you look at what's happened this year, you got to be taking a good hard look at how you try to forecast this.
I mean, there are a lot of folks that we are reading a lot here at Yahoo Finance and we're quoting and talking to, and it's like, it continues to be, well, it will happen just in the future, right? There will be a recession for all these reasons, consumer excess savings come down, yada, yada, yada. We've talked about this a million times, and it's just not clear that 6 quarters into that argument, we need to say, well, just wait a couple more quarters. And I do think, to your point, Julie, I think the street is struggling with that in their outlooks. And look, it's very conservative how they're written, very staid and all these things. But like, you can tell if you read this stuff enough and for long enough, as the three of us have, you can see there's a real struggle on the street with like, how do I make sense of something that has not really made sense in, God, we're going on the 4th year, right? This is gonna be the 4th year post-pandemic of trying to figure out, since COVID started, of like, how do we think about this? I don't think anyone has a good answer.
All right, Myles, thank you for joining us today. Appreciate it.